What's up, guys? Welcome back to another episode of Behind the Facade, and not just any episode, but today we are doing another one of my Rewind series interviews, and that is where I take you right back to some of the earliest interviews that I did on this podcast back when it was an audio only podcast. And so I have video recordings that I made at the time, but have just been sitting in a file for all this time. And so today's episode, I'm going to take you back to March 2021 in the middle of the COVID pandemic. And this is episode number 48 with Adam Lawrence. Now, Adam is a Birmingham-based property investor, business owner, and at the time of recording, he had assembled a portfolio of 430 housing units, and he had built this portfolio from scratch over a period of 10 years, starting around about 2011 with his first property, and in just one decade, he's gone to plus 400 units. I found Adam to be super smart and capable of explaining the various strategies that he employed during this period of scaling his business. And so I think it's going to be really, really useful for you guys. So please, without further ado, sit back and enjoy my conversation with Mr. Adam Lawrence. Adam Lawrence, great to meet you. How are you today?
I'm really well, thanks, Gavin. How are you?
I'm good. We were just chatting there before we hit the record button, and I was saying that our paths crossed because Rod Turner of the Rodcast asked you. He interviewed you, and I was asked to appear on Rod's podcast a few weeks later, and I kind of thought, oh, I better go and check out, the Rodcast. What's this all about? And I heard you speaking to Rod. And I was thinking to myself, bloody hell, that's going to be a hard act to follow. So I am really thrilled to have you here today, Adam. It's a great pleasure to have you on board. And for the purpose of we actually have quite an international audience listening here. So for the purpose of the people who would never have heard of Adam Lawrence, I know you're well known in the UK property circles, but for those who wouldn't know, can you just give us a quick summary of who is Adam Lawrence?
Sure thing, yes. So pretty non-vanilla career background, really. For my stripes, I suppose I did some time in finance and wealth management, and the rest of the time I've been gainfully entrepreneurially employed, doing one or two or 100 things at once, really, like typical serial entrepreneur, really. So I've been in property seriously for 12 years now. I was an accidental landlord back in 2008, so pretty typical sort of story. Made all my mistakes in one go, bought a new build property, top of the market, '06, with the wrong partner at the time. I'm not sure you can make many more mistakes than I made there. We parted company in '08, and so the only realistic way around that was to let the property out. Found out I was getting pretty much tucked up, really. So became a more active landlord, and then picked up another property without being too sort of clever about it, really, and thought, the great financial crisis had sort of paved the way a little bit. The interest rate had gone through the floor. There seemed to be lots of opportunities around. So I live in Birmingham in the West Midlands. I was born and raised there, although I lived in Switzerland for a couple of years when I was working in wealth management in Geneva. And so had the local area knowledge, had the opportunity, could get to a lot of rooftops within about an hour's drive of my house. And decided I would follow a sort of comparatively high yield but fairly vanilla strategy. So I've stuck with HMOs at the start, and then buy to let much more seriously going forward, including an element of social housing in that. And then as I've sort of graduated a bit, I've also picked up a few bits of commercial property along the way.
Interesting. Well, we're going to get into all of that today. And to kind of bring us back and paint a picture, you're from the Solihull area of Birmingham, and you went to Oxford University. Let's just go back to that. You left university. What was the first job that you kind of did leaving university?
That's a great question. So before I was I went off to Switzerland when I was around about 25, I think I was. And before that, the post uni, I actually played online poker for a while and just about managed to pay the bills doing that. That was the really early days of internet poker. And I also, I worked a couple of casual jobs because I really hadn't found what I thought I was going to be an investment banker. And then I just completely fell out of love with that idea and was kind of left a bit void, really. I didn't really have a backup plan. So I worked a couple of casual jobs as well. And also, I paid my way through university, rents and fees and things like that by playing fruit machines and cards with some of the guys at university. So I worked out ways of making that pay for me. And then I graduated onto online sports arbitrage trading. So a bit like baby version of the stock market, really, fairly unsophisticated at the time because it was the real early days of internet betting. So I used to bet fairly significant sums to make relatively small profits, but those profits were locked in and guaranteed before an event would start. So those were the days before bookmakers would just close you down at the drop of a hat, because obviously that sort of business is not business that they want, and it's quite dangerous business for them. And I made some money doing that, but then the opportunity came up to go out to. So a bit of a career change, really, from online punter to wealth manager. But there was some probably more similarities than the wealth management industry would like me to admit, Gavin, if I'm honest with you.
Yeah. I was just thinking that it's funny. I lived in Spain for a period of time, and my kids went to this international school, and the kids that were in her class, in my daughter's class in the international school, they were all the big names of online poker, gambling, all that. I mean, the big names that you kind of see,
Yeah.
And all of their kids were actually in. So I used to have a card game with all of these, famous names in that space, and one of them actually didn't know how to play cards, and he was making literally millions on the game online, but he didn't know how to play it actually in real life. So it was hilarious, kind of figuring this stuff out.
That is funny.
I knew sports betting was in there somewhere, and it's going to be an interesting conversation for one of our listeners today. I was speaking to somebody during the week who's actually doing something in online gaming and stuff, and he was talking to me about building a portfolio. So I kind of said, listen out for this interview today now, because building a property portfolio with a sports betting background is kind of in that space. So tell me about this time in Geneva. You were there for a couple of years, and what was it like just to get out of the UK for you?
Oh, it was fantastic, and it was the Swiss financial market at the time, and advice and consultancy and wealth management and all the rest of it was, like it still is really, was light years ahead of the UK. So they were already moving towards a much more client focused model. Low cost funds, all the stuff that you've seen sort of take over, whereas the old IFA commission model was still sort of rampant in the UK in the mid sort of 2000s. Lovely in that, had a great job, great place that was, job included an apartment to live in, bills paid for, that was fantastic. Fair bit of flexibility as long as I worked pretty hard, so I still got those investment banking hours in, just not in the investment banking industry, one way or another. Phenomenally expensive. I remember it being about £9 for a beer 15 years ago. So I don't know what it costs now, but it must be eye-watering. But I was putting so many hours in that realistically I didn't see too much of the outside, really. Weekends were good fun. The air quality, the quality of life there was spectacular. But when it came down to it, and I really wanted to get myself onto the property ladder, it was a choice between a €700,000 flat in Servette, which is not the best part of Geneva by any stretch of the imagination, or a £250,000 house in the UK that was a brand new build and all singing, all dancing in a pretty decent part of the UK. So I thought, well, can I make this work? Yeah, exactly that. And it's all very well earning the big bucks, but if you are then commensurately paying out the big bucks, what do you actually get to see out of it? And I think I went to Geneva with a really low level of financial sophistication, because the old story. They don't teach us that at school in the UK. I didn't really have that guidance from anybody else, or I'd never sort of sought the right person out to teach it to me. So I was in Geneva, I was consuming all these materials, books, seminars, all this sort of stuff, because I was a portfolio builder, as in that was my role as a portfolio and eventually portfolio relationship director. So I was getting involved in the mathematical side of it because I've done quite a lot of mathematical stuff, and obviously the arbitrage betting is highly mathematical as well. And it was great fun, but I felt I got to the point where I couldn't go much further. Like I said, I wanted to get on the ladder. I saw a massive opportunity back in the UK for actually better. I'd started by that point to get banned by quite a lot of online bookmakers, as I was saying earlier on. So my brother had actually finished his university course, and I corrupted him and persuaded him that me and him should team up and start a bricks and mortar cash betting operation. So he would go around the shops and I would sort of pull the strings from the desk. He would put the bets on, I would lay them off. We would make some money that way, and we expanded that operation to go quite a bit further. And that sort of took us from when I came back from Geneva, which was 2006, right up to, so I blew through the financial crisis without too much exposure to anything apart from that one property.
Wow.
And of course, gambling, when the economy downturns, gambling goes on an upturn. So 2009 was one of the best years that I'd had. And in about sort of 2010, early 2011, a few things changed for me. Got married, had my first son. I was living a lifestyle where I would bet on US sports as well. So obviously the time difference made that quite... I used to have an old Nokia phone with the old... Do you remember the old...
Yeah.
Yeah. I used to have that. It used to go off at 2:00 in the morning sometimes. And my wife is a very understanding woman, but when we got to first baby stage, she said, that's going to have to stop, don't you? And I was like, I get that, So I needed a complete focus shift. And I saw the opportunity in property and just thought, what's not to like here? After the market readjustment, what's not to like, really?
Yeah, huge adjustment. And just, before we get on to that, I was going to ask, were there any fundamental lessons you picked up in the wealth management industry that you applied, that you brought with you? Yeah.
Gavin, I always say I've invented absolutely nothing. There's some geniuses out there. Tim Berners-Lee invented the World Wide Web. I've invented nothing. I've read some stuff about Warren Buffett. I've read some great case studies when I did my MBA. Everything I've done, I've taken from somewhere. And wealth management, number one, diversification. Absolutely. Number two, a really interesting one was I saw what people's attitude towards taxation was. And I saw how it would make them make quite what I would call foolhardy decisions, really. So we had quite a number of clients who, if you said to them, would you like 10% returns but pay 40% tax? Or would you like 5% returns tax-free? They would rather have the 5% tax-free, even though it was a lower return.
Yeah.
And some of that, as I get older, I understand some of the rationality of that, because these guys felt they paid enough tax. That was the bottom line. They had huge tax bills anyway. And they just thought, I contribute enough. And then, of course, that sort of leads you towards social impact investing and things where the returns are not the only fruit, which, of course, it wasn't really a thing in 2006 or 2005 that I remember anyway.
Yeah.
Yeah, big lessons, really. Big lessons.
So when was the decision? You mentioned that you were an accidental landlord. When did you make the decision to become kind of seriously looking at this?
So early 2011, as that sort of shift came, lifestyle shift for me, things got a lot harder in our bricks and mortar gambling op as well. So it was all a matter of timing, really, I suppose. And property networking in England at the time wasn't much of a thing, but it was a thing. There were meetings going on, and I decided, my dad was still working at the time, and he was a tax and trust advisor. So he said to me, you're interested in this stuff. Why don't you come along to this networking meeting? I'd like to try and get a bit of business out of it. And so I went along to a few with him, found a few that I liked, found a few that I didn't like, and thought, this is a good place to learn. So I'm inherently super impatient, like many entrepreneurs, and I made a promise to myself. That I would not do anything. I wouldn't pay for any courses, wouldn't do anything like that. 6 months just learning. And that felt like 20 years to me, absolute. But I did it. I dug my hands in my pockets. I paid my 20 quids to get into the meetings or whatever. And I just drank in the knowledge. And I met some really great people there as well. People who were, a fair way down the track, who are happy to spend a bit of time, just really enthusiastic about property, love what they do, can talk about it for hours and hours, just like we can, I'm sure, Gavin.
Yeah, all day long. Tell me this then, when you got, so it was starting to come onto your radar, and when I listened to you on the Rodcast back in, it's a year ago now, you had 200 properties at the time, and I understand you've kind of gone to double that. But let's go back to just the first couple of transactions when you made that decision that you were going to get serious about it. Like, what was your first deal or two deals that, and what was the process that you started to go through?
Great question. So I decided I wanted to partner with people, because I thought I would struggle. Look, from my days in wealth management, and also when I worked in the sort of arbitrage field as well, I knew that I wasn't strong at everything, and I don't really think that anybody is, to be honest. And so I thought, right, supplant my weak points with partners. So I found people who were experienced in it, had bought well in the past, had done HMO, which at the time had really attracted my attention, because, look at those headline fantastic yields you can get, you know how it works. And there were still areas at the time, sort of 2011, 2012, where there weren't many HMOs at all. There were an absolute handful of them. And there were whole towns where there was demand and there was very little supply, or the supply that there was really, really poor standard, really poor quality. So it really was sort of very low hanging fruit. So I partnered with a couple of guys who'd built a portfolio of 10 properties themselves. Of course, me looking back, thinking I had 2, was thinking, wow, these guys have got 10. That's amazing. You look at people who are ahead of you, don't you? And luckily, because of my background and also what my dad did for a living, I structured a joint venture such that I was quite well protected, so that the downsides wouldn't affect me too badly. And the other guys involved would get paid based on their performance and hitting the figures and the targets that we set ourselves. I knew nothing then about the challenge of trying to revalue properties up when you've bought them at a keen price. I knew nothing about building. I knew nothing about renovation. I still can't wire a plug. I'm not proud of that, but it's just, that's not where my skill set lies. Absolutely. I didn't have a clarity of vision around the whole strategy. I thought, look, yes, you can get a discount. What sort of discount can you get? I don't really know. I'm going to find out. Financially, I was somewhat sophisticated, but still had a long way to go. Refurb-wise, not sure. Management, just thought it was easy back in those days. What management? They just pay the rent, don't they? So that was all a bit of a baptism of fire. We managed to source some funds from somewhere. I had a little bit of money to put in as well. As I say, I'd structured it so I was protected. And we bought a couple of HMOs. A flip project, a house that had been illegally converted into 2 flats. That was my first sort of taste of the legal side and the paperwork side and all the rest of it. And then a couple that were just sort of vanilla buy-to-lets. Then I was completely out of money. The other person we'd approached for money was completely out of money. And I always say that's when I really started to learn, because once you're tapped out, that was bringing in a relatively small amount of money each month. And at the same time, I had an opportunity to do an MBA with a full scholarship. So that came up, that was 2012, Warwick Business School. I just couldn't turn down, supposed to be 30K's worth of fees. And I thought, well, this is a brilliant, brilliant opportunity for networking, for raising funds, for building the business, And so I went and did that. That was a 12-month course. So I wasn't actually out of the game during that 12 months. I did have a little bit of money left that was saved up, but I then needed an armchair solution because the MBA was all consuming, Yeah. So it was my first experience of getting involved with a portfolio building service, of which, of course, there are a whole number of them out there, and seeing the pros and cons of that and sort of working through that. And that didn't work out very well for me, unfortunately. But again, you pay for your education one way or another, don't you? that was it.
That's interesting. Yeah, I was just going to ask you about that because, 2011, 2012, that was a period when certainly in the Irish market, the prices were through the absolute floor. There was nothing lower. You couldn't really get much lower. So you must have been spoiled for choice in terms of, opportunity. How did you decide where you were going to buy and, what were your kind of criteria that you were looking for?
Yeah, super question. So I live in a relatively low yielding pocket of South Birmingham. And I was always quite married to the idea of yield and cash flow. Again, taking from those other business case studies and books and all the rest of it, cash flow is the biggest thing that scuppers a business, isn't it, ultimately? So I was quite married to getting high yield, and there were quite a lot of choices around my local area. I went for a bit of a mixture. So one where there was a significant amount of infrastructure investment going in, and there were really, really good motorway links. And this particular town had quite a wealthy, affluent city nearby. So it was a bit of a starter town, feeder town for the city. And you could buy under 100k GBP at the time and get decent yields, 7% gross yields on single lets. And I just thought that there's an inevitability about the geography. John Lewis had just made a big investment there. How things have changed in 10 years. M&S had just put a huge investment in it. I know a little bit about the sort of due diligence and market research those guys will do before they go into an area. So rather than even pretending that I could do that level of work, I just thought, well, I'll just piggyback. I'll piggyback what they're doing. The Waitrose effect, but in a slightly, Waitrose tends to come a bit later in the chain. Does a bit late by then normally. So I was piggybacking other people's big companies' decisions, and also my criteria at the time was, I know I've got to travel a bit to do this. I want to start within 45 minutes of home. And then as confidence grew and I worked on sort of remote management systems and things like that, I then went, an hour and a half, 2 hours, Scotland, mainland UK. And I'm stuck at mainland UK at the moment, but, I wouldn't write anything off at the moment.
Well, I think actually that's probably a good idea, because my forays into international markets didn't plan out as
that's a common. I always hear one or two things, Gavin. Either I got my money back and I was lucky, or a lot of effort and a lot of heartache, unfortunately.
There's always stuff that you learn after the event, and you kind of go, why didn't I even know that was an issue? But your home system and the fact that you've got people all around you that are telling you, that won't work, this won't work, and stuff. When you're in a foreign market, you're just ripe to get kind of either ridden, or you're just going to make a simple mistake that nobody else would make in that market.
Oh yeah, if you haven't got an exceptional team there, unless you either drop really lucky, you've got a fantastic introduction, I mean, I'm also obviously lucky being in the UK, we've got a really solid legal system and the land reg works really well. So that obviously is what attracts some of the money that comes into the UK market as well. And that obviously has fed a lot of that growth, especially down in the south and southeast where I'm not really involved. Has fed a lot of that growth between that sort of 2011 period and sort of 2016 when it started to come off the top,
Interesting. In terms of, so in 2011, you bought a handful of properties. When did it start to ramp up to, 30, 40 properties or whatever? At what stage were you at when that started to be the number?
So I was involved in a few different entrepreneurial ventures, and one of them was going reasonably well. And a couple of the guys who were involved in that said to me, effectively, we haven't really got anything particular to do with the money. And a few months before that, an old business partner from years before in a completely different venture had called me up and said, look, we've just inherited about £500,000. We're looking to do something with it. We'd like to deploy it into property. And we know you, we trust you. Would you fancy doing something together? So I said, well, I'm sure we'll be able to spend that pretty quickly. We managed to find a pretty good unbroken block of flats that was yielding quite well, and sort of put that £500,000 into buying that cash, and then went through the process of improving them and refurbing those. And then these other guys they were making some decent money at the time. They wanted someone who could be a bit operational in a partnership and just buy reasonably well and grow a bit of a portfolio. So I became the executor, I became the sort of operational role really, and learned the ropes, learned a lot of what I said I didn't know there, learned a lot of that as I went along. And I was quite open and honest about not being, the finished, not that I'm the finished article today by any stretch, but not being the finished article at the time, but I'm honest and I'll try hard and I'll be transparent, and I'm pretty good with numbers and budgets and spreadsheets. So that's what I can offer. And then So worked through sort of buying on, just using agents to start with, because of course when you're relatively new, there's a lot of talk at network meetings about other ways of getting properties, but that was the way where the vast majority of the stuff changes hands, of course, in the UK on the open market with traditional agents, and then got into auction, and then sort of graduated a little bit further into dealing with some of the fast cash buyers, the wholesale operators that operate in that obviously little niche of the market that exists over here, but really can deliver some deals if you get to work a good relationship with them.
Interesting. Yeah. I was going to ask you, your portfolio has grown now to such a size, but I mean, where would you say the economies of scale start to make sense? Because obviously 20, 30 properties, it's still very management intensive. What stage did you start to feel like this is starting to now become like an operational sweet spot?
Yeah, really, really good question. I mean, I wouldn't even have used the phrase asset management back then at all. It was about 40 where I started to hurt quite a bit, because I had a sort of part-time helper helping me manage the portfolio, and I did a bit of a time audit, and I was spending about 30% of my time on maintenance and queries and filling voids and stuff like that, even though I wasn't using many agents to manage the tenancies. We were managing the tenancies, but of course they were still helping find prospective tenants and things like that. And I looked at it and thought, well, hold on, 30% of my time on these tasks that are not high value tasks. Yeah. I've got to do something about this. So that was where I started to think, like you were just saying, in terms of economies of scale. And I definitely have some diseconomies of scale as well, which I'm happy to talk about. And I started thinking, right, I've really got to get into agency. Why did I want to do that? Well, I wanted to understand about best practice in the industry. Who's going to know how to manage properties and tenancies any better than the professional agents, was my thinking. And like I said, I've borrowed a lot of stuff from big business in the past. Why not take that step? So I went and got myself trained and qualified as a letting agent, and I made a big decision. The big strategic decision to make was, should I start one from scratch, or should I try and buy an existing one? Typical entrepreneur, I decided to do both in the end, but bought into a couple. One of them worked out really, really well. One of them's not worked out so well, but managed to exit without too much blood on the carpet. And then started one which is more of an in-house vehicle. So it doesn't have that sort of, we haven't got loads and loads of different landlords. We haven't got big marketing budgets. We haven't got big flashy offices or anything like that. So it's more focused on the delivering returns side of things, which of course is where you need it to be on the commercial side. So I've been lucky to get a fantastic business partner in the East Midlands who already had an agency that was set up as a proper business. He doesn't work in it day to day, doesn't need to. There's a system, there's a place for everything in its place, etc., and we've been able to do some good deals with that local presence that we've got there, and that's led to a number of advantages, in terms of keeping costs reasonable, in terms of deals and visibility in the locale, in terms of there's not much competition in that immediate area because there's not enough rooftops really for another bit of competition. So if you can find a little area or a little niche where you can dominate, obviously there's significant advantage to that. So there was as soon as I sort of moved away from, I'm not going to be doing the tenancy and property management in any way on a day-to-day basis. I still want to know. Obviously, I need to know the big stuff that's going on, but I still want to know the mechanics and the process and the legals, so I can oversee that effectively. But as soon as I moved away from that, I started to get real economies of scale, because that was when I then decided, right, the hard bit of this game, well, it's all hard, isn't it, really? But the hard bit of this game is finding the deals. That's what most of the people I would ever speak to would say. And so I thought, right, I'm just going to put 75%+ of my time into finding deals. But not just finding deals, finding people who can find deals. So I'm quite an accomplished relationship builder. That's definitely something I put near the top of my skill set. And I just went and asked questions and probably annoyed a few people, but took the time they would give me, and then worked out as well, what would the business angle that could come out of this sort of stuff. So if you've got people who want to flip properties and they're finding 5, 6, 7, 10 deals a month, how could I get into their black book? Could they sell some stuff to me? Could we work something out such that it worked for them? So one of the ways I've worked really well with wholesale traders, for example, is when they haven't got to buy a property in, it's obviously saving them legal, stamp, all the rest of it. We can execute very, very quickly because of the financial structure that we've got and wholesale bridging arrangements and all sorts of stuff like that. So once that relationship of trust is built, we can pay them a fee. And what we're bringing off the table is the stamp duty, the lag, all those lagging costs that they don't want. They know now they can get a deal, they can give it to me, and then they can carry on. It's like the used car salesman, they can get a next car. They'd rather take 500 quid every day for a car than 5 grand every 2 months. And that's commercially very sensible, isn't it? So exactly that. So that was having the time to do that was a massive economy of scale, because, you make your money on the way in and all the rest of it. I don't truly believe, I think you make your money on the way and you make your money during the life of the asset and you make your money on the exit. That's the reality. But you need to get good at all of those three things, really. Otherwise, you're going to leave a lot of money on the table at some point. Mm-hmm. So that was definitely my first economy of scale. But then, of course, the diseconomies start to creep in, because instead of, we've got 1 or 2 projects on the go and I can drive around and have a look. Now it's like, wake up one day, we've got 43 projects on the go and I can't get around any of them realistically, because they're also, some of them 90 minutes away, 2 hours away. So I need that sort of support team and all the rest of it to be able to make that work.
Wow. In terms of, say, risk mitigation, obviously COVID-19, how has COVID-19 affected the business with furloughs and unemployment and all that kind of stuff?
Well, obviously on the trading side, it was a really tough time, because we had as an offshoot a little auction buying business that would locate, appraise and purchase stock at auction, sometimes for us, sometimes for other investors who are clients of ours. And that basically became unviable overnight because auctions shut down. Not so much, we weren't worried by the online nature of it. It was the stock compression that just made all the prices just shoot through the roof. So staff in there had to go on furlough. Property management wise, it was a funny one really, because that first, we're obviously sort of a year on as we're having this conversation, but that first lockdown, we were already doing quite a lot of stuff remotely. We got quite a lot of remote systems in place. So we only took 2 or 3 days to go fully remote. We were able to do, we could let properties without anybody seeing it with video walkthroughs and key safes. We were already set up to do that. And so that was all COVID compliant. And if people needed to move, obviously we were only moving people who needed to move, but people were phoning. And of course, a lot of the agents had pulled all of their stock. So I got involved in that side of it. I didn't have a hell of a lot else to do because I couldn't find any deals or go to meet people. So I got involved in that side of it. And I was getting regular phone calls from people saying, I live with mum and dad. They're in their 70s. I really need a place. I'm looking at this place. And I was like, look, we can do this. We can check you in. We can reference you. We can get this done in 24, 48 hours. That's no problem. So we got to May last year and we had 0 voids. And at the time, like you say, we'd have been at, low 200s in terms of stock. And I can't remember 0 voids for 7 or 8 years before that. So in a way, the challenge of COVID had sort of passed by then. Of course, until furlough and everything was announced, we were sitting there thinking, what's going to happen if everybody doesn't pay their rent? Well, because of the high yield strategy, one of the first pieces of analysis we did was we looked through the whole portfolio. We put in the LHA rates for every property and said, right, okay, assume tomorrow everyone's on housing benefit, right? The whole portfolio, what does it look like? Are we broke? Are we still cash flowing and all the rest of it? And yes, we were still cash flowing reasonably healthily. So, of course, there would maybe been a period of transition, which wouldn't have been very nice. But then by then, we were just starting to talk about doing things like, can we get people to pay 6 months, 12 months up front and give them a discount, give them 10, 15% off, get the cash in and start hoarding it. And then Rishi opened his magic suitcase and, we were all very happy about the furlough scheme that was announced because, I found very, 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 we've had nearly no problems that we wouldn't have had organically in a normal year anyway. Couple of tenants who've swung the leg and used COVID as an excuse, but they would have been non-payers at some point in the future. Yeah. But luckily, these are the sort of, 1% that slip through the net, even though we've got a pretty good referencing process, it still happens. And because, my biggest commercial purchase to date was in December 2020. So that was obviously with full sight of what's going on with COVID, and that was why the purchase came about.
Right.
The other stuff, my tenants were quite lucky. They seemed to fit into the right sort of business rates band to get good grants. We worked out payment plans. They're just sort of mum and pop businesses, really. So they got hit a little bit, but not had major arrears to deal with. Didn't get into sort of supplying PPE and like some people did. I think I missed the boat on that one, definitely. But
Jeez, everyone's like that,
yeah. But it's not been. It's been pretty good from a from that sort of risk perspective. Well, vanilla buy to let. What this is the whole point of being in the low risk. It's not sexy. It's pretty boring. But when that riskometer just goes through the roof, guys I know who are buying hotels with significant amounts of leverage, I'm not hearing from anymore. It's as simple as that. Whereas if you've got, and the real sensible and big commercial and resi portfolio holders that I know, sensible amount of debt, sensible amount of cash on the balance sheet to weather a storm. Here's the storm. They've all weathered it reasonably well. So it's been a textbook crisis in that way, hasn't it, really?
It has, yeah. In terms of, so risk management, mitigation, I mean, I was listening to you when you spoke with Rod, you were talking about, you've spread your risk by having different locations, different sectors, different demographics, different socioeconomic kind of stuff. And even you went down as far as your banking and your JV partnerships that you've de-risked that by not having such a dependency on one or two. Talk about that. Is that just come from your wealth management, the idea of diversification?
So certainly the diversification across sort of geography, employer, tenant type, socioeconomic, stuff like that. Absolutely. I mean, when COVID hit, around about 25% of our rents were coming from social housing lease style arrangements, so much more of a commercial arrangement in a resi property, and that 25% was, we were looking at that on the spreadsheets thinking, well, we know that's coming in, that's pretty damn good news, actually. Nice anchor for the portfolio, gave us a lot of confidence to continue trying to build throughout what's been a really interesting sort of 12 months. The bit regarding joint venture partners and banking and all the rest of it, banks, yes, I diversified because in 2008, I did get, because as I mentioned, I was doing a significant amount of gambling transactions. You try doing that today through your personal bank account, they'll close you in 50 seconds. I got an account closed by a big bank in 2008 and just thought, what the hell are these guys doing? There was cash in there. I spoke to someone very senior in the bank who happened to be a friend of mine, and he said, look, you're not a profitable customer, and it looks like you're running a business through that account. So they're not interested in your custom, And I just thought, right, I better have. I went out that next week and I opened an account with every single bank and building society along the high street and just said, right, that's never going to happen to me again. I'm never going to let that dependency. So that lasts a long time in the memory. Regarding the partners, I actually had a really good meeting with a consultant in about 2013, wouldn't have been long after I bought that block of flats with the JV partner who'd inherited the £500,000. And he said to me, well, do you realise there's a big dependency here? What if this guy goes under a bus? What if he gets divorced? What if he goes bankrupt? And I just thought, blimey, I like to think I'm quite good on dependencies, but there was definitely a dependency there. And that sort of lit the fire to go out and work with more partners on different, tweaking the strategy a bit and saying, right, we're not all going to step on each other's toes. I don't want a big run fight for one deal.
Yeah.
Let's build a particular strategy that suits us. So I've got some JV partners who are looking 10 years in the future and they'd like to exit a company and they want completely hands off. They just want to leave it all to me. I've got some who want an active role in the analysis and the deal finding and the legals and the operations and all that side of it. Well, that's brilliant because that takes some of that operational pressure away from me. And of course, they're at partner level, so they're incentivized properly. They make the right sort of decisions. I've got some who are in trading businesses who are happy doing what they're doing. I've got some who just want a wage because they don't want to take all these risks that the likes of you and I have taken over the years, and so it all tessellates in quite nicely to, if one partner wants to, I mean, we've obviously got our shareholder agreements with different clauses in place and things like that, but I tend to try and standardize them. And then I also know that I've got partners behind who, if one partner did want to exit one business, I've got people who probably like to buy straight in and just buy the shares. So I'm not dependent on any of those. I've got my own investments, my own assets and all the rest of it, such that no one person going rogue, going missing, changing their mind
pulls the whole thing down. Yeah,
exactly. And that was very much from the one meeting with the consultant. I must credit him for that, because that was it really stuck in my mind. I just thought I've got to dedicate some time to really. And now I look at I call it the Jose Mourinho, 2 world-class players in every position if you can. So at least 2 solicitors, at least 2 mortgage brokers, at least 2 insurance brokers. And I always tell everybody that I do business with that that's the case, not in order to sharpen their prices, but just so they're aware. I mean, I had when you get to a certain level, banks want to interview you not at the moment, but generally face to face. And, one came down from Manchester and said to me, well, what does it do? What does it take for us to get all our business? I said, it's just an impossibility. You'll never have more than 25% of my business, because that's my own personal, I see the bigger picture for me as a portfolio of portfolio loans, because you just can't rely on one. Of all the people I've learned lots and lots off over the years, people have been in the game 30, 40 years. And the only thing that had ever gone wrong for them was post 08. 08 was okay, but post 08, when banks turned around and said, well, sorry, we've changed policy. We've changed policy. We don't want your business anymore. You've got, general terms, you've got 60 days. 60 days to move a portfolio. Now, obviously, luckily, sensibly geared and all the rest of it, but still, just find, in the bottom of a recession, find 50 grand for a load of valuations, and try and negotiate a rate when there's only one lender at the table and all the rest of it. And I just thought, right, that's not happening to me. No way is that happening to me.
Wise move. Yeah, definitely. In terms of, okay, so 1 year ago, I listened to your interview and you had 200 properties. You told me just now you have 430 properties or something like that. So you've doubled the portfolio during COVID, which is pretty remarkable. And I just want to know, I mean, looking forward now, do you plan to continue growing like that? Do you see that there's just as many opportunities as there was in the last 12 months going forward?
Well, there's a bit of a, it's a bit like buses, isn't it? You buy portfolios, you want to buy portfolios, 2 come along at once. One we were working on pre-COVID, from sort of August 19, that didn't settle until December 20. That was 91 units on its own. So that made a massive difference. Okay, yeah. To those figures. We don't have any 100 property portfolios in the pipe at the moment, unfortunately. We've got a few sort of 6s and 10s and 20s and 40s, but nothing that big. And then another one was sort of 37 units wrapped up in one deal as well. So in terms of numbers of deals that we did fewer deals in 2020 than 2019.
Just with larger numbers, yeah.
Just with larger numbers, yeah. But it's current. I mean, it's been quite tough at the moment with our auction stuff sort of kicked out. We would always organically pick up 15, 20, 25, 30 from the auction side. That we picked up 1 or 2. It really has been that dramatic. And then the direct leads and the cash buyers and all that, their stock has, they've all started spending less money on their lead generation and all the rest of it, and their stock shrunk and this is the way it is in a seller's market, isn't it, realistically? So it has been tough, and I don't think, as we go in March, I think we've agreed 2 deals in March, and we're negotiating on a couple of others. Whereas we obviously expect to be doing, in terms of just deals rather than numbers of properties, 8 to 10 a month realistically in this day and age. So we really need that market to calm down a bit, to be honest, Gavin. I'm comfortable as long as the overall LTV is sensible. We're not overstretching. We've still got places we can get cash from. I'm releasing about 20 units later this year, which have got a lot of equity in them. So that just puts the balance. It was one of those situations where someone's made us an offer for a block of flats that we just can't refuse. It's well above the market value, and I just think, well, look, I can replace that at market value. So I'd be crazy not to do the sale. But of course, 20 units needs replacing, doesn't it? So I'll be going. The overall. I'd be very happy if we bought 50 a year and sold 25. I'd rather do that than buy 25 and be cash poor because we're always putting money into stuff. So it does, but the appetite is to get to 10,000. Just because, look, you've got to pick a number. I've been forced to pick a number by my one business partner. And I said, well, is 1,000? No, I think we can do more than that. So what about 10,000? Can we do it in 10 years? Let's see. See.
Watch this space. Tell me that. I mean, looking at that now, one of the things that I'm kind of watching because of my corporate kind of expertise is that there's a ESG, carbon footprint, all of this kind of stuff. This in the space that I work in, that is a massive consideration these days. Have you seen any of that yet, or is that not really coming into the picture yet?
I mean, at the consumer level, no, but I totally agree with what you say. And I think the impact really on Resi is at the EPC level.
That's
UK,
the energy ratings, isn't it?
That's right, the energy performance certificates. That's right, yeah. So, until sort of 2016, it was a non-issue. They then wanted 2018 onwards properties to be at a standard of E or above. Well, there was only about 7% of properties that were below an E in the private rented sector. Some of those were exempt anyway. Not really. Some of those you changed a couple of light bulbs for LEDs and you passed the certificate. So that's not a fair reflection. But of course, with this sort of rush now towards zero carbon, and of course, big announcements from the government, 2030, no new petrols and diesels.
Yeah.
It's 2021, it'll be 2022 before we all know it. This is incredible pace. And then this EPC consultation that happened at the back end of last year that wants to see landlords get rental stock to C or above. Well, you've got an issue there because now instead of 7%, you're talking about 70%.
That's right.
And when you look at your standard Victorian terraces and the likes, they need some pretty extreme action sometimes to get above a D. They need solid wall insulation, which a lot of areas don't like, which costs a lot of money, which is problematic if it's not done really well, or they need solar PV. Sometimes they need both. And 10K a property, it's an obvious point to make. But if your stock is worth 100K and you've got to spend 10, that's a 10% investment. That's really significant. If your stock's worth 500K, it's annoying, but it's 2%. It's not a big deal. So you're going to if you don't invest in your assets, they're going to depreciate ultimately. So, I've got to see yet how are RICS going to treat that in terms of valuations. How are mortgage lenders going to treat it? We've already had a bit of a teaser because some mortgage lenders are offering small discounts for energy efficient properties. Yeah, absolutely. And I think we're going to see more of that because they're being incentivized to do that by the Bank of England.
Yeah.
So that's
I've seen 0.5% here in Ireland.
Oh, as much as that? Wow. So, I mean, that's really significant. I've only seen sort of 10 or 15 basis points at the moment, but
so gas and oil-fired central heating, that is something that is being banned here. And then at a certain point in the future, you'll have to replace existing with new products. And so that's a significant investment at some point in the future. And when you've got 400 properties in your portfolio, you start to kind of do the math and say, geez, this could be a significant expense. So it's definitely...
Absolutely. I mean, it's interesting. My strategy has always been to try and not buy anywhere where I really wouldn't want to live. And I sort of put some colour around that by saying I don't really want more than 40% of the stock in that area to be rental stock because I want there to be an established retail market. I want a retail market exit if I need to sort of move some of these on. So, I mean, I've just built a energy efficient based on the passive house principles property for myself to live in out of the ground, although I'm not out of the ground builder by any stretch of the imagination. And that's got an A EPC and it's got an electric boiler. It's got no gas. Strangely enough, typically, although it takes months to get utilities connected up, while we were building, Cadent actually knocked on the door and said, would you like us to do the gas? We could do it today for you. And I said, actually, you're okay. We're not using gas. So the electric boilers have come a fair way, of course, and that might tessellate in with the solar PV. I think solar's the big opportunity. Make no bones about that. I think there's a lot of, electric car chargers. Obviously, that brings different challenges in terraced houses with cars parked really, like you're getting in an Oxford or a town like that in England. It's incredible. But I think you're right. It's an interesting thought. And to be honest, I'm thinking, I mean, we now we have done for a while, look at deals in a slightly different way, because we'll often start with the energy performance certificate and see what's going to need to be done in the future. But we're also, I am to an extent taking a bit of a punt on there being a fairly significant grant scheme to upgrade some of this stuff. And because when you look at the number, we need to spend something like 20 billion on the UK housing stock in order to achieve these energy performance ratings. Well, yourself, a bit of cladding comes up and everybody wants the government to pay. So there's going to be probably, the way they've taxed the fallout of Grenfell might be something they're going to continue with in terms of carbon offsets. I also think there might be an opportunity to do what they do in some other countries, where there will be off-site solar farms and things like that, where you might be able to purchase some credits and stuff like that. So, I mean, it's difficult when you're in the unknown, of course, but because we keep sort of relatively sensibly geared, because we've got really good rent cover on our cash flow, we're in quite good shape compared to your average private sector landlord. So I always think, we're at the back of the queue to get mown down when something goes wrong on the bright side. So we do have that level of protection. But I know what you're saying. People who think, I used to see it all the time and think, why isn't this landlord just putting 10 or 15k into this property? It'll be worth 25 or 30k more than they're going to sell it to me for. But then as you get through the life cycle of properties and stuff, you understand people make a few sort of basic errors around that. But also, they can also look at these things and think, well, I bought that for 20k 30 years ago, or 10k or whatever. I've made a lot of money out of it. I'm happy. I don't want the hassle anymore. So I hope we don't get to that stage, because we've got a bit more of a long-lasting mentality. But yeah, there's definitely risk there in terms of these measures, and you've got to be able to work through them and hopefully get a bit more notice than we sometimes get from respective governments when they decide suddenly it's the next big thing,
That's the thing. I'm wondering what's with COVID and it's very unpopular, a lot of the lockdowns and stuff, and you'd have to wonder what will that do to the government's prospects in the next election, and whether there's going to be a big fallout and all that. So it's interesting. We'll watch this space. I'm just moving forward to 2017, and I see you set up Partners in Property, and we were talking about networks earlier, and so this is your own network that you started from scratch. Tell us about your thinking in that regard.
That's right. Yeah, that's right. I went to I was talking earlier about networking and going out and meeting people, and I had a great affinity with the independent networking scene very early on. I found that you got more experienced people there. I found they were much more generous with their time. And I think that I then worked out that's because the more corporate side of the property networking side is just set up as this huge funnel to pour people into to sell them training courses, So that's fine. That's a separate business. That's not really networking in my eyes. So I stopped going to those in 2011. I gave it about 6 months doing that and thought, this is not for me. I'll stick to the independent scene. And I was lucky enough to be invited to some really good private meetings that were not even marketed or advertised at all in sort of 2014, 2015. I met some really, really high-level people there, some of whom I still do business with today. And I just thought, what a shame that there isn't a network that has that sort of no agenda, but will get these serious players to give some of their time to it and give it some airtime. And so that's how Partners in Property was born. We had a great venue that someone was willing to give to us. We had a lot of support from people. And Sue Sims, my co-founding partner, Sue just had, a really nice way about her, really genuine, really open and honest. Again, no agenda of her own. Works really, really super hard, really honest. What more could you want? So we co-founded Partners in Property. It was one little meeting back then in Birmingham, or out in Worcestershire. Actually, it was a lovely venue. And then we got a couple of other partners involved who were also, property heavyweights who could help us scale the business, give it more credibility. And we took it to London, we took it to Manchester, Southampton, Bristol. Now it's online, of course. But we, again, responded to the challenges, I think, with COVID, started putting out a lot more online content. And people needed that interaction. I know we all get a bit of Zoom lag and stuff these days, but if we hadn't had these video calls, some of the last year would have been really, really miserable, wouldn't it? You know, so we've really sort of carried on with that, and we've just set it up as what it is. It's a monthly membership community. There's no contracts, no tie-ins, no hidden agendas, none of that. We have some sponsors in order to help keep the costs down because we've got some staff, obviously. But the sponsors are all people that we do business with. They're not. I've had lots of other really, really poor business sense in that department. So I've had lots of people approach me and say, "We want to sponsor you," and I've said, "It's not really how it works at Partners in Property. I'll come to you." Sorry, it might sound a bit arrogant, but it's kind of the way we. I've been very conscious of being the gatekeeper, and you can never protect everybody, unfortunately. But we try our hardest. That's all we can do, Gavin. Really.
Yeah. What would you say is the biggest shift in your mindset since you got involved in property in 2011? Has there been anything that you've completely changed direction? And curious.
I mean, certainly when I bailed, I'm quite an early adopter, but I'm also quite early to get off a curve if I don't like the look of it. So one of the big shifts was when I moved away from HMO into just doing vanilla buy-to-let, and then HMO/social housing HMO. That was a big sort of shift on the operational side. But one of the big keys that unlocked things for me were, rather than spending all this time running around trying to raise money and give away big chunks of equity to people, also starting using bridging finance intelligently. That was a massive, massive game changer for me. And of course, let's not forget, in the background between sort of 11 and 15, that interest rate was coming down and down and down. So suddenly you were getting bridging loans at 8 or 9% a year, which didn't look in any way unreasonable if you could do volume and you could condense that time it took to sort of flip deals around. So unlocking the bridging was a big one. And then also just from when I did my business administration masters, taking that strategic viewpoint on the whole of the business and saying, right, okay, where are the bottlenecks today? Where are the bottlenecks in 3 and 6 months' time? And what actions can we be taking now in order to minimize those bottlenecks? So when you come back to your sort of economies and diseconomies of scale conversation, so that what's going to stop? Where's the glass ceiling? Why is it there? Can we get through it? When we get to this point, what are we going to do? Usually we already know what we're going to do because we've planned it out. So I suppose that strategic side of application, rather than house quite cheap, got some cash, buy house, rent to tenant, a bit more. I'm not saying it's rocket science, anything that we do at this end, definitely, but we have tried to make it into a proper business strategy rather than just be a residential property landlord,
Yeah. And I see on your LinkedIn profile, there's a reference to Boardroom Club. What's that?
So I actually work with Rod in that. Rod and I were talking about this sort of late 2019, early 2020. We wanted to run a group. It's Rod will laugh, but we always say it's a bit like our therapy, really. We don't want to be property gurus, trainers, and all the rest of it. But we actually both really get a kick out of helping other people with their property businesses and their associated businesses. So we said, look, we'll make a promise to each other. We'll give this a try. We'll see how it goes. We won't do, loads and loads of it. We'll do one session, one group of up to 10 people or 10 businesses. Then COVID came and we thought, well, it's just not the right time, is it? Then COVID got about 2 months in and it was like, actually, it really is the right time because people are really, really want this stuff right now. So we thought, we'll give it a go. We started it in June 20 and we were lucky enough to get 7 businesses who are willing to be our pilot bunch. And we helped them build a 12-month strategic plan. We worked through that with that all the way through from their sort of vision and mission, which is not, Rod and I are not big on fluff, as I think but we need to do that stuff and then get that all the way down to their focus areas and then objectives and KPIs. So we take that bit out of corporate, the stuff that works for you. And then we have that monthly Zoom session where we will be your non-execs, effectively. You're going to present your board statement and your KPIs to the board. You're going to present your management accounts. You're going to talk about your challenges. And as a bit of something, because Rod and I love the sound of our own voices as well, we do a little 1 hour slot in the middle, which is a deep dive into. So we've done some of the big deals that we've done. We've done systems and processes. How do we find deals? how do we appraise deals, financing structures, all sort of, and really whatever the group wants to hear, really. And we've had some great, we did a great one on systems and process where it proved to me that the delegates in the group have got better systems and processes than Rod and I have got. So fair play to them.
That's brilliant. And do they pay for that, or is that?
Yeah, they do pay for it. Yeah, they pay on a 3 monthly basis. We ask people for a 6 month commitment, but we want them to stay for 12. But like everything we do, we're not up for contracting and tying in. We want people to stay because we're delivering value. That's it. Yeah. So, we that's charge for that time. It is honestly really, really fulfilling. Really enjoy it when we have a Boardroom Club day.
Yeah, it's a little bit like starting this podcast. This podcast was actually a lockdown project that I started, and it was the feedback that I got was so rewarding that it's kept me going. It's motivated me to kind of. This is we're talking today on episode 48. And I haven't missed a week in 48 weeks now, and it's primarily because of how rewarding it is to kind of get the feedback from the audience and stuff.
Well, I write a Sunday article that I post now, and I've started taking it more and more seriously because of the feedback I've been getting has been so good. And now the Sunday supplement's a thing. And now if I get to Saturday and I haven't written it, I think, oh God, I've got to do the supplement. It's like being back at university or something. It's like I've got an essay to write for tomorrow, and I've got to do it now. But it is really fulfilling. I really love it. And I can totally relate.
I can totally relate. I've been up on Sunday night at 10 o'clock starting the podcast for Monday morning's upload. So I understand that. Adam, we're coming to the end. I wanted to ask you just a question I ask pretty much everyone. First of all, the best advice you ever got?
I think for me, and this is very much my personality type, I think if any listeners have done Myers-Briggs or any other sort of Jungian personality test, I'm an ENTJ, which is not uncommon for entrepreneurs.
INTJ.
Right, so not a lot of difference really, because it doesn't really make a big difference to our proclivities that make a big difference in business. And someone who told me very, very plainly, just because you can doesn't mean you should.
Yeah.
And that was a great bit of advice to me, because I'm quite creative. I can get distracted by stuff. I know that. And that one, when people have said to me before, oh yeah, but we could just do this and this and this. I was like, but look at how complex that. Yes, we can do that. But how complex is that compared to this deal that we just did, or this deal, or this? So remembering that, I think has been. I say that at least once a week to someone who's around me. Just because we can doesn't mean we should. So definitely, that would be my number one piece of advice to pass on.
Keep it simple.
Yeah, absolutely. Yeah.
Good advice. KISS. Keep it simple, stupid.
yeah, absolutely.
And the last question, Adam, is if you had an opportunity to speak to your 20-year-old self, what advice would you give yourself?
Stop spending so much time in pubs and arcades playing fruit machines, maybe. No, I think what I would say is I'd have taken some of that money I had at the time and I was putting back behind the bar on alcohol or whatever, and I'd have put it in houses, of course, Gavin. So I'd have said, look, build the portfolio you can as soon as you can. There's so many cliches in property, but some of them hold a lot of water, really. And one of them is, the best time was 30 years ago, but the second best time is now. So that's what I'd be saying. Don't over leverage, but don't sit on the sidelines. I see people all the time who have a fear of not doing the perfect deal. And that's so damaging, because they can be 2 or 3 years. And then now at the moment, those people are turning around saying, oh, it's really hard to buy. And it's like, we've been talking about this since 2018. There have been opportunities since then. You've just got to take them. So I think, it would be I'm sure people have said it, but go back in time and buy more stock, really, Gavin, realistically.
That's it. Don't be the perfectionist.
Yeah. Done beats perfect. A good friend of mine, Neil Martin, says it that way. Done, and that's another really good little 3-word. Done meets perfect.
Yeah.
Done beats perfect. Sorry.
Done beats perfect. Adam, it's been a great pleasure. How can people find you if they want to reach out and connect with you?
So Partners in Property has got a very active Facebook page that people can follow. I've also got my own profile on there, Adam Lawrence, which you can follow. And I'm also a moderator on the UK Property Traders Facebook group. It's got about 33,000 people in now, alongside Rod and lots of other really great people. And also on LinkedIn, Adam G. Lawrence on LinkedIn. So can find me on either of those quite easily, Gavin.
Great stuff. Well, Adam, I wish you the best of luck, and I'll be checking in with you next year to see if you got 800 or 1,000 properties under your belt.
Really enjoyed that, Gavin. Thanks ever so much for having me on.
All right, guys, I hope you enjoyed that interview with Adam Lawrence. Now, I'm actually inviting Adam to come onto the podcast, and it's almost exactly 2 years since this Rewind series. So do look out for that new interview that will be up in a couple of weeks' time. In the meantime, what I'll do is I'll put you through to one of the latest episodes that I've done here on the podcast, and I will see you very, very soon. Take care.